Q suites, track, build, execute. The Fed is pushing back on the AI rate cut narrative, and what happened overnight in Japan just made things more complicated. Let's break it down. Here's what you need to know this morning. 1. The quant model says risk on. Current regime is bullish growth, bullish inflation. 2. Positioning is aggressive. 78% leverage tech, 22% cash. No bonds. No gold in the quant portfolio. 3. The macro strategist says 60% stocks, 30% gold, 10% cash. 0 Bitcoin. 4. 9 of 11 sectors are bullish. Only financials, tech, and consumer discretionary are at half position. Now let me show you why this matters, and what could change it. Let's start with the overnight news that actually matters. First, and this is the big one, some Fed officials are now arguing that AI productivity gains could mean higher interest rates, not lower. What it is, a direct challenge to the Warsh and Trump administration view that AI equals disinflation equals rate cuts. What it's doing, creating divergence within Fed thinking. This is hawkish pushback. Equity impact, bearish for risk assets if this view gains traction. Higher for longer compresses growth valuations. Second, Japan just posted the fastest export growth in over 3 years. 16.8% in January, driven by AI chip demand. But here's where it gets interesting. SoftBank is central to U.S.-Japan investment talks. Japan is expected to invest $33 billion in a massive Ohio natural gas facility through SoftBank. What it means, bullish for Japan exporters, bullish for energy infrastructure. The IMF is urging Japan to keep raising rates. Third, Meta is deploying millions of NVIDIA processors. They're also adopting NVIDIA's Grace CPUs. That's a blow to AMD. Arista Networks fell 3% on the networking shift. This is NVIDIA continuing to consolidate AI infrastructure. Here's your 60-second class for today. The quant model is showing risk on regime. But what does that actually mean? The model tracks 2 indices, growth and inflation. Right now, growth is at 10.01. Inflation is at 10.04. When both are elevated and rising, you're in risk on. That's where we are. What it is, the macro environment most favorable to equities. What it's doing, supporting aggressive positioning, hence 78% in leveraged tech. Equity impact, stay long risk assets until the regime changes. The model will tell you when to cut. But here's the nuance, write this down. The regime can flip fast. If those Fed hawks gain traction on the AI productivity thesis, inflation expectations could re-accelerate, growth expectations could stall. That's how you get stagflation. Let's talk economic data. Inflation, CPI is at 2.39% year over year. Core CPI is at 2.51%. What it is, the Fed's primary inflation gauge. What it's doing, trending toward target, but still sticky in services. Equity impact, neutral to slightly bullish. Not hot enough to force hikes, not cold enough to justify aggressive cuts. Labor, initial claims at 227,000. Unemployment at 4.3%. What it is, real-time pulse on job market health. What it's doing, stable. No stress signals. Equity impact, bullish. Labor market supporting consumer spending without wage spiral risk. Rates, 10-year yield at 4.06%. 2-year at 3.43%. What it is, the bond market's view on growth and inflation. What it's doing, curve is normalizing. Long and drifting lower. Equity impact, mildly bullish for duration-sensitive sectors. Now let's look at what the quant model is actually doing. Current positioning, 78% in leveraged tech via TQQQ. 22% in floating rate treasuries. 0% in bonds. 0% in gold. 0% in Bitcoin. This is aggressive. The model is max long tech because the regime supports it. Year to date, the model is down 7.48%. That sounds bad, but the S&P is flat. The model's drawdown is normal within its volatility band. What it means, the model is staying the course. No defensive rotation yet. Here's something to watch. The 2-week correlation between VIX and SPX is negative 0.78. That's typical. But VIX itself is down 8% overnight to 19.48. Volatility is compressing. That's bullish near term. Let's run through all 11 sectors. Bullish at max position. Materials, communication services, energy, industrials, consumer staples, real estate, utilities, healthcare, and S&P 500 broad. Neutral at half position. Financials, technology, and consumer discretionary. Write this down. What it means, the rally is broadening. Small caps, mid caps, value, and momentum are all bullish. Quality is bullish. The only factor at half position? Growth. That's IWF and QQQ. This tells you the market is shifting from concentrated megacap tech to broader participation. Here's what the signals say to own and avoid. Bullish gold, bullish silver, bullish gold miners, bullish base metals, bullish Australian dollar, British pound, Canadian dollar, euro, bearish Bitcoin, bearish Ethereum, bearish agriculture, bearish the dollar, neutral on oil, neutral on broad commodities, neutral on the yen. This is important. The macro strategist has 30% in gold. The quant model has 0. That divergence tells you something. The strategist sees geopolitical and inflation risk. The model sees pure momentum in tech. Finally, the big picture from the macro strategist. 60% stocks, 30% gold, 10% cash, 0 Bitcoin. Beta-adjusted S&P delta is 71.2%. That means real equity exposure is 71% of a fully invested portfolio. What it means, bullish but hedged. The gold allocation is insurance against the regime flipping. The strategist is saying, stay long, but don't get complacent. The Fed hawks, the Japan flows, the Geneva talks. Any of these could shift the narrative fast. Here's your cheat sheet. These rules are yours now. Rule 1, follow the capex. Metaspin tells you where AI infrastructure is going. Rule 2, regime determines position size. Risk on means max exposure. Rule 3, watch the 10-year. Below 4% is equity friendly. Above 4.5 is a headwind. Rule 4, drawdowns are normal. Regime changes are the signal, not price action. Rule 5, when tech and financials lag, it's rotation, not reversal. Rule 6, when gold is bullish while Bitcoin is bearish, it's a risk-off hedge bid. Rule 7, when the strategist diverges from the model, both are telling you something. Screenshot that. Use it today. That's your morning brief. Regime is risk-on. Positioning is aggressive. But the Fed is throwing curveballs. Stay sharp. Trade the data, not the narrative. See you tomorrow.
Hi, good morning. This is Matthew Mickey. Doing the board game for Wednesday, February 18th, right? So starting on the daily chart, doing NQ. As we talked about yesterday and this morning, right? We knew that this previous day high had the higher probabilities after the close, right? We know that our 30th percentile and our 60th percentile, our highest probable reversal zone right now is between 24,990 to 25,041, right? So from 989 to 40, this is the highest probable high of the day zone, right? So there's your numbers right there. Screenshot it, lock it in, right? Going on to the weekly look, right? We're above Sunday and we're above Tuesday, so we're locking this in as low of the week. We have targets for the week at 25,369, which has an 84% probability of being hit, and we have target at 25,499, right, which has a 75% probability of being hit, right? So there is a 75% probability that this will be an engulfing weekly bar, right? Now, if we come back into this Sunday range, which we're currently at, then that lock takes out that weekly low lock-in, right? Looking at the weekly low from a statistical standpoint, all right, let me see if the MFE was statistically sound, right? Let's let it load up, right? We can see that right now, the way it's looking, there's a 51% chance that this is the low of the week, right? We know that the mode and the median are behind us right here, right now, right? So bulk of the data for this being the low of the week is behind us. So now we can anticipate the high of the week. So we know if this is the high of the week right here, we know that this was 100% level. This is 90, this is 80, this is 60, and this is 50 from a weekly standpoint, right? So this median MFE at 25,369, right? That lines up with this 50%, right? This is a high probable high or target for the week, right? Now we're going to go into our intraday, right? And we see that London, right, was long true none, Asia was long true none, London was long true broken. So now we're going to pull up the daily profile, and we're going to start using that, finding the probabilities on that, right? So long true none, long true broken, and like we broke out to the long side. Right, so we know that there's an 82% probability of going false. So we're going to start with the false narrative, right? We can see that that current low of the day that happened at 1800, right, is still anchored as a statistical low of the day, right, from a time and price standpoint, right? Right, so 0.1 to 0.3 is where the mode to median is off of Globex Open. And we met that at 0.29. So we went to the extreme of the price, did it in the hour that the low of the day typically happens. So we're expecting that to hold, right? Now, right, for the high of the day, right, we can see that the high of the day, we can anticipate a high of the day between 9:30 and 10:15 or the end of day, right? Those are the two dominant times, but the 9:30 to 10:15 looks like the most consecutive version of it, right? One thing that stands out to us today is that the Asia OU, which is below us, has a 73% probability of getting filled, right? And that mode happening between 9:30 and 10:15, right? So we can see that this Asia OU at 24742 is a high concentrated reversal zone. But before, we've got two possible scenarios, right? We've got Asia, settlement, and Globex within this 30 handle range. And then we have what was London OU, which has already been hit. Now we have midnight and P12 mid. Now we're expecting a bounce off of P12 mid, which is representing this, right? We're expecting, right, this is our high of the day zone that I've already drawn out, right? So we're expecting a bounce around this P12 mid area and this midnight area, or we're expecting a reversal around Asia OU settlement and Globex, right? So now that we've gone long false, we kind of got the keys to this story, right? So let's go to our levels, right? And look at this. We see that that P12 mid has a 93% hit rate at 9:30 to 9:45. We see that that P12 low has a lower probability, but if we are going to hit that P12 low, right, we can do it anywhere between 9:30 and around 11 o'clock, right? We see that settlement on a Wednesday, the 25% gap fill, the 50% gap fill, the 75% gap fill, and the 100% gap fill all have 73% or higher probabilities of getting hit, right, and being filled. We see midnight has an 80% probability of being retraced to today based off of what Asia and London has done, and the primary time being 9:30 to 9:45. Right now, we're about to hit that. Well, we already hit that midnight right here, so that's already checked off. So we know 1, midnight open, 2, P12 mid, 3, Globex open, and 4, settlement open are our high probable retracement zones before we bounce to make a new high day, right? So I am looking at doing this, right? 9:30 opens up, it sells. I'll take targets to these locations, but then I'll ultimately be shooting sells for cash flows because I'm looking for a reversal to happen either at P12 mid or around settlement, right? I'm not expecting a new low day. If we get a new low day, I will take off trading until 10 o'clock and then reassess, right? And start rebuilding my analysis. Right now, what I'm saying is that I'm expecting this high of the day for us to make a new high of day, right? In this zone between 24,996 and 25,048, which naturally lines up with, candle signs. So we got two independent variables, right, pointing to the same high of day, right? So that's my war game for today. Like I said, I'll take 930 sells into these high probable retracement levels, but then I'll ultimately pull TP quick because I'm looking to start buying into a reversal after 9:30 around these areas, right? So that's my war game for today. Hopefully it was helpful, and that's it. Bye, everybody.